Have you ever wondered how massive insurance companies survive when a multi-billion-dollar hurricane wipes out an entire coast? How do they avoid bankruptcy overnight? The standard business model is pretty straightforward. You pay a regular premium, and in exchange, the company takes on the financial risk if your property gets damaged. But behind the scenes, there's a vital safety mechanism. The moment that insurance provider collects your check, they take a small piece of it and go to an even larger global bank. They use that piece of your money to buy a backup policy for catastrophic events. By doing this, the insurance company locks in the remaining cash as guaranteed profit. If a historic disaster does strike, their losses hit a hard, impenetrable wall. They know their exact worst-case scenario before the storm even forms. You can actually use this exact same playbook in the stock market. Instead of just buying shares and hoping they go up, investors can structure trades to generate steady income while strictly capping their downside risk. It's a mathematical approach called the bull-put spread. Think of it as setting yourself up as a small-scale insurance broker. You collect an upfront premium and build a hard floor against a market crash. This chart shows the recent price movements for a technology company called Cloudflare. You can see a healthy upward trend, with the stock currently priced at $82.55 per share. The first step in our playbook is to sell a put option. In plain English, you are offering a crash insurance policy to another investor who owns this stock. You agree to step in and buy their shares only if the stock plummets all the way down to $70. Notice how much breathing room that gives you. The price is currently well over $80, so the stock would have to take a significant hit before your insurance policy ever kicks in. As the person providing this insurance, you don't do it for free. You immediately collect a premium of $268 in cash, deposited directly into your trading account. You are getting paid upfront cash right now, simply for promising to buy a stock at a major discount later. Getting that $268 right away is great, but stopping here is extremely dangerous. If the company suddenly goes bankrupt and the stock goes to zero, you are on the hook for a massive loss. We need a safety net. To protect your portfolio from an unpredictable, catastrophic drop in the market, you have to buy your own backup insurance. You take a portion of that $268 you just collected, and you go down the chain to buy a lower put option, your own disaster policy at the $65 mark. This screen displays the pricing table for these options. If you look at the row for the $65 strike price, you'll see the cost to buy this backup policy is $157. Let's look at the final math. You collected $268 for the policy you sold, and you paid $157 for your own safety net. That leaves you with a net profit of $111, yours to keep. This order confirmation shows exactly what this two-part bundle looks like before you execute the trade. You are selling the $70 policy and buying the $65 policy simultaneously, locking in that maximum profit of $111. By sacrificing a fraction of your upfront income, you have essentially traded away an unpredictable, high-stakes gamble for a position with a hard mathematical ceiling on its risk. Once the trade is live, your primary job is to do absolutely nothing. You just wait for the contracts to reach their expiration date. Professional traders choose the $70 insurance line specifically for that safety cushion. By picking a price far below current market value, you stack the odds in your favor. Mathematically, there's a 79% probability the stock stays above that line and you keep your full profit. Compared to traditional investing, this gives you an enormous margin of error. The stock can climb higher, it can trade completely flat, or even drop a few dollars. In all three scenarios, you win. But what if the absolute worst happens? What if the stock price drops to zero tomorrow? This risk profile chart maps every possible outcome. Notice the flat green line extending left. Because you bought the $65 disaster policy, your maximum loss is mathematically hard-capped at exactly $389. No matter how deep the market crashes, the bleeding stops right there. Compare that to a traditional investor holding 100 shares of the stock. In a major crash, they could easily lose thousands of dollars. Your risk is strictly confined. The bull-put spread changes your role in the market. You are no longer a gambler hoping a stock happens to go up. You are operating like the house, collecting consistent premiums, knowing your exact worst-case scenario, and letting the probabilities work in your favor.